My name is Michael Lennard, and I'm Secretary of the UN Tax Committee and also Chief of the International Tax Cooperation section of the UN's Financing for Sustainable Development Office. I've been asked to moderate this session about the new IGF practice note, and that's a pleasure. Thank you for the invitation. It's a very helpful note, and we'll hear some very expert speakers today about some of the important aspects about tax treaty practice in resource-rich countries, because there are some special issues in resource countries. So I'll give a little bit of brief introduction about why tax treaties are important. And I realize this is a diverse audience, so all of us will be trying to speak to the diversity of the audience. Tax treaties play a key role in international cooperation on tax matters. A good treaty can encourage investment and also the transfer of skills and technology. So sustainable development, which is so important to the UN and to all of us, can be advanced by good treaties which encourage those sorts of transfers for skills to jobs and so forth. On the other hand, they do try to reduce cross-border taxation on the same profits. I'll talk about that a little bit in a minute. But they are complex and they're difficult, and they usually are enforced for 15 years or so. So you have to get it right when you're negotiating, and you also have to keep your treaties in review. And practice notes such as the IGF practice note released today are really important in both of those tasks. It complements a lot of guidance in the area from the OECD, from regionals, and from the United Nations, amongst others. In the United Nations, we have a model tax convention, which is a model of tax treaty, but also important because it's not just a model for the text of the treaty. It actually has a lot of commentaries in it, which discuss different options and which discuss the pros and cons of the different options which are available. And like all the UN work, that is very much focused on developing countries. The UN Tax Committee, which is responsible for that guidance, is a 25-person group, which is selected by the Secretary General, and they act in their own capacity, but they are almost always people from ministries of finance and people from the tax administrations, and they have that expertise, and they're a majority from developing countries. In the UN Tax Committee, there's quite a strong majority for developing country representatives. Obviously, there are all sorts of different interests amongst developing countries, but resource-rich developing countries have been very important in the UN. The UN, as a consequence of that, also has a handbook on taxation of the extractive industries. And a new version of that is imminent. I'll put in the chat a link to the UN Tax Committee publications, and our colleagues at IGF have played an important part in that work. There's also a UN manual for negotiation of bilateral tax treaties between developed and developing countries. And that has been very influential. It came out in 2019. It will probably be adjusted slightly for some of the changes of the new UN model, but that's something I will also draw your attention to. And the Platform for Collaboration on Tax Toolkit on Treaty Negotiation, which is the UN, the World Bank, the OECD, and the IMF, that actually draws quite heavily from the UN work. So with that background, you can see the importance we place in the UN on good treaty practice and the importance we place on work such as this practice note. So what are some of the key issues, just in background before we have IGF colleagues talk about the note itself? Why do treaties matter? Well, first of all, the issue is that international income and capital taxation revolves around two main concepts: the concept of source, where the income arises, and the concept of residence, where the person who receives the income resides. And under their domestic laws, taxation on both of those bases is quite legitimate. most countries tax to a greater or lesser degree, both on the basis of income sourced in their country and also income earned by their residents. So obviously in the international context, you can have a problem where income, essentially the same income, is being taxed twice by both the place where it arose, the country where the mine is, for example, and the country where the residence of those who derive that income is. Now, that can be dealt with in domestic law. In a lot of cases, domestic law provides that if income is already taxed in the source country, the residence country will reduce its taxation to a greater or lesser extent. But treaties give some confirmation that that legislation will not be changed tomorrow, that there's a treaty obligation to continue that. But and it is in the interest of both governments and taxpayers that, as far as possible, income is not taxed twice in the two different countries. There are provisions in the treaty which we'll hear about it, see about in the note, and those provisions provide that they formalise this the residence country deferring to the or giving a credit or an exemption for tax already paid in the source country. So that's an important aspect of encouraging investment and encouraging the investment that leads to sustainable development. There are some other aspects which are really quite important. One is that treaties have a provision where if there is an issue about whether there's double taxation, whether the treaty applies, the two representatives from the two countries, tax representatives, competent authorities as they're called, will come together and try to resolve that. In some cases, there's binding arbitration, but in most countries with developing countries, it's not a binding arbitration system. It's just the best endeavours by the competent authorities to try to resolve the issue, which again is generally in the interests of both countries to try to resolve that for their longer term relationship. Another aspect of treaties is that they are often used to reduce what is seen as excessive taxation by source countries on some international investments. So countries will often have a withholding rate, which might be very high, might be 30% or something, and the treaties often reduce that. And that's a provision where it's very important that you determine what level you want to reduce it to, and you don't create a hole in your treaty, your bank of treaties, where one treaty is more preferential than the other, and that can be used for so-called treaty shopping, which you'll hear about today. So that's another aspect. There is a third aspect. There is certain aspects of the treaty which provide that types of tax discrimination for the foreigner against the resident in the jurisdiction. They're addressed by the tax treaty to try to reduce some of those aspects of discrimination in the area of tax. And that's quite a nuanced area, but an important area. The other thing that the tax treaties are often not given the credit for, but it's very important, is that they do try to reduce the uncertainty and complexity of the language that's used. We have at the international level two main models, which is the OECD model and the UN model, and there are also regional models in Africa, for example. And those models are all very important, and they actually share a lot of commonality in the language. And it's very important that the language be as far as possible, the meaning be as far as possible the same when two different countries are joining together in terms of a treaty. So that's an important function. That's why the commentaries of the OECD model and the UN model in many respects are the same, are an important part of the contribution of tax treaties to try to get this common language between those who are participating. There's more consistent interpretation if the common language of the UN or OECD models is followed, And if you differ from that, then that's not a problem. You just have to be transparent and have to make sure that there's an understanding about the differences between the two parties. Finally, another aspect of tax treaties, which wasn't seen as so important as in the past, which wasn't seen as so important then, is that tax treaties are now seen as not just about avoiding the double taxation that I've talked about, but also about avoiding double non-taxation. So as part of the OECD base erosion and profit shifting work, there was some strengthening of treaties, particularly around the concept of permanent establishment, to make sure that there was less opportunity for abuse of treaties. And that's something that the UN has followed, and there are aspects of the UN model which have been followed by the OECD model, such as in respect of offshore indirect transfers. So more and more treaties are not just seen about avoiding double taxation, but also about avoiding double non-taxation, which is such an important issue to so many countries and to the citizenry. So with that background, we will hear today many expert speakers on some of the issues that I've mentioned and other issues that may arise in the mining context, particularly in negotiation and in the administration of your treaties. But before that, I'll pass to Alexandra and Jacqueline from the IGF, and they'll give an outline of the IGF practice note. Thank you very much. Over to you, Alexandra and Jacqueline.
Thanks very much, Michael, and thank you so much for being our moderator today. It's wonderful to have you with us. As you said at the start, I think there's a strong connection between the work of the UN, in particular in the Handbook on Extractive Industry Taxation, and the practice note that we're here to share today. The UN Handbook contains an excellent chapter on tax treaties in the extractive sector, which is undoubtedly the foundation for this product. So thank you for being with us, Michael. And thank you to my fellow panelists as well, Tuxu from Mongolia, Amadou from Senegal, and Carlos from Argentina, who we'll come to shortly. But mostly thank you to our audience for joining us today, particularly as we're at the end of the year. I appreciate that everything is very busy for people, so we're glad that you could make time to join us on what is a very exciting occasion. For us to launch, to formally launch this new IGF guidance for governments on, as part of our program of work on tax-based erosion and profit shifting in the mining sector. So today we're here to discuss the new guidance specifically on tax treaties and mining, written together with my colleague Jacqueline Takiri, who you'll hear from shortly. So this guidance is really intended to help resource-rich developing countries negotiate fairer and more sustainable tax treaties. We are going to briefly present some of the key findings and recommendations from the guidance, which is now, as of today, available online in English and will shortly be available in Spanish and French as well. Jacqueline, if I can ask you to move to the next slide. Thank you. So Michael's already given us, I think, a very helpful overview of tax treaties and the role that they play in international taxation. But perhaps just to reiterate that once more, particularly for those in the audience who are less familiar with tax treaties or taxation more generally, you know, what are tax treaties and how do they work? And you can see here a little diagram of how tax treaties work at a very simple level, which is that they are international agreements that assign taxing rights between two states on income from cross-border transactions. So in this case, you can see that the treaty limits the abilities of the source state, which here is where the mine is located, to tax income earned by non-residents in their jurisdictions. And it also limits the abilities of the resident state, in this case where the investor is located, to tax its residents on their worldwide income. So in effect, treaties determine how much of the profit each of these countries gets to tax. And as Michael's mentioned, there are many model conventions upon which most treaties are based, including most notably the OECD and the UN model conventions, and you'll hear us refer to them quite a bit today. And these are, you know, model conventions. They set out how tax treaties should look like, essentially. What are the articles? What is the contents of a tax treaty? But there are also regional models prepared, for example, by the African Tax Administration Forum and other regional bodies. There's some very important differences between these models. These models have more in common, I think, than not. However, there are some important differences nonetheless. However, our guidance is largely interested in how resource-rich countries deviate from these models to better protect their right to tax mining income. As Michael said, there's no obligation on countries to follow the OECD or the UN or the ATAF model to the letter, as provided that any deviations are transparent and well justified. And I think that's what we're interested in, is how are other resource-rich countries modifying or adapting the model conventions in ways that are intended to better protect their right to tax their natural resources. And so our work in this practice note is really trying to focus on this question of treaty practice. What is it that countries are doing in practice in their tax treaties? How are they modifying the language to better serve their objectives as resource-rich countries? If I can go to the next slide. Thanks, Declan. Perfect. So I think the first question is really, should resource-rich countries sign tax treaties in the first place? Tax treaties have become somewhat controversial over the years as potential vehicles for tax planning and tax avoidance, treaty shopping. As Michael said, perhaps treaty shopping is where investors will use tax treaties to reroute investment and income flows, potentially increasing the risk of profit shifting. So tax treaties are not uncontroversial, and I think there's very different views as to whether or not developing countries in particular should sign tax treaties. But of course, that's a sovereign decision, and many countries do determine that they would benefit from tax treaties for one reason or another, in which case, how they negotiate and design those tax treaties becomes very important, to do so in a way that is going to protect their tax base. However, in the mining sector, I think it's very important for resource-rich countries to look at what are the costs and benefits of signing tax treaties in the mining sector specifically. Now, when you sign a tax treaty, you're not signing a tax treaty just for the mining sector. Clearly, it's going to affect all economic activities. However, if you are a resource-rich country that relies heavily on mining revenues, then it is going to be important to consider these costs and benefits in light of this sector in particular. So what are we, on the benefit side, many developing countries have used tax treaties to attract foreign direct investment, to boost economic development. I think ultimately the evidence for the effectiveness of tax treaties in achieving this benefit is mixed. And I think the role of attracting investment in the mining sector is particularly uncertain. The role of tax treaties in attracting mining investment is particularly uncertain. Why? Because firstly, mining is location specific. So this means that tax competition in general, including the effect of tax treaties, which might lower the level of taxation in the country where the mine is located, is likely to be a less significant factor in mining investment decisions. And this is true for tax incentives and other issues that we work on at IGF. So mining is location specific. It is ultimately the resource that is most important in determining investment decision making. The other factor that's relevant, perhaps in moderating the impact of tax treaties on attracting foreign direct investment in mining, is the role that mining concession agreements play. So in many countries, certainly not all, but in particular in many developing countries, there are mining concession agreements which will be specific agreements that govern the arrangements between a particular mining investor and the state. And often these concession agreements will include bespoke fiscal terms, and these fiscal terms might be potentially more favourable to investors than what the treaty offers. It may also be that the concession agreement is flexible enough that the investor can choose to apply the treaty benefits should they turn out to be more favourable than the fiscal terms in the concession agreement. So it allows a degree of flexibility and optionality on the part of the investor. So the prevalence of mining concession agreements may temper the impact or the relevance of tax treaties in terms of attracting mining investment. So I think these are two quite important considerations in the mining sector that further that raise further questions about to what extent tax treaties are useful in attracting foreign direct investment. So that's on the benefit side, maybe additional foreign investment, but it's uncertain, and in the mining sector even more so. There are benefits in terms of dispute resolution, potentially access to information from other countries, treaty partner countries. On the cost side, however, we have loss of tax revenues of potentially if the tax treaty provides a lower level of source taxation, lower withholding tax rates, for instance. There may be the risk of treaty abuse, in particular double non-taxation, as Michael mentioned, and they can be costly to negotiate and to administer. So there are benefits and costs to entering into a tax treaty in general, and it's important to consider those in light of the mining sector in particular. If I can move on, thanks, Declan. Perfect. So ultimately, uncertain benefits and widely recognized risks. On to the next slide, thank you. And these risks are material, I think, particularly the revenue loss. So this is not just hypothetical. Our practice note documents a number of instances where tax treaties have led to a loss of tax revenue for the country where the mine is located. And we've identified three main risks arising from tax treaties in relation to mining revenues, which we focus on in our practice note. The first is the taxation of offshore indirect transfers of mining assets. So tax treaties may prevent source states from taxing profits from the sale of shares or comparable interests in mining assets located in their country. The second risk that we look at is the taxation of subcontractors. So we know that there's been a huge growth in the use of subcontractors in the mining sector. Now, it might be easier for them to structure their activities in a way that allows them to avoid having a taxable presence in the source country. So the taxation of mining subcontractors is a key risk. And then lastly, the taxation of fees for technical and management services. So tax treaties might prevent source states from collecting withholding tax on payments a mine makes to foreign companies in return for services. So these are not the only risks that tax treaties present, but they're what we consider to be the most material. And you can see from that infographic on the slide that the most material is the first one, the taxation of offshore indirect transfers of mining assets. So where the sale of a mining asset takes place offshore. So these risks are not hypothetical. They add up to hundreds of millions of dollars in terms of treaty disputes that have arisen between contracting states and potentially significant loss of revenue for the source country in particular. So not a hypothetical risk, a very real one, and therefore making it particularly important that when negotiating and designing tax treaties, we consider these risks and how to adopt language and a treaty policy that will limit these risks and the impact on the tax base. Over to the next slide. Thanks, Declan. And I'll hand over to you here. Thanks.
Thank you, Alexandra, and welcome everyone to this launch of this practice note. My name is Jacqueline Takiri. I'm co-author of the practice note, and it's very nice to see you all. So as Alexandra has mentioned, there is some information available on tax treaties and the extractive sector. Notably, however, as Michael mentioned at the start, the United Nations Handbook on the Taxation of Extractive Industries has covered different important aspects on tax treaties and extractives. However, this is the exception. The fact is that there is few guidance for resource-rich countries on how to deal with tax treaties issues in the extractive sectors. So in this context, what gap is this practice note filling? This practice note seeks to fill two gaps. The first gap is guidance for government officials in resource-rich developing countries on the design, but also on implementation of a specific tax treaty articles. So basically how to design specific tax treaty articles in a way that they do not limit their ability to collect mining revenues. And the second gap is basically to provide insights into what resource-rich countries basically do in practice, right? So basically, as Alexandra mentioned, how do they modify, how do they adapt their tax treaties to better protect the right to tax mining income. And much of the guidance that exists is based on the OECD and the UN model conventions. However, this practice note tries to go beyond these models, analyzing over 80 tax treaties and in some cases also domestic laws to provide concrete examples of tax treaty practice among resource-rich countries. As you can see, the goal of this practice notes is basically to provide insights for the benefit of resource-rich countries on what they can do to learn from the experience of other countries. If we go to the next slide. As I mentioned, we think that IGF survey of the IGF survey of tax treaty practice is basically the primary contribution of this practice note. The survey included 86 tax treaties signed by developed but also developing resource-rich countries, and these treaties were selected to achieve a mix of countries and treaties based on different criteria. So basically, we mix resource-rich and non-resource-rich, high income, low income, high tax, low tax, and also we made sure to cover different regions and geographies, including the Africa region, Latin America, and the Caribbean, and also Asia. In total, we covered 18 countries. And so, as I mentioned, the goal of the survey basically was to assess how developed and developing countries, resource-rich countries, have modified the treaties to better protect the right to tax this mining income, with focus on specific tax treaty articles that are most relevant for extractive industries, which are basically Article 5 on permanent establishment, Article 6 on income from immovable property, and Article 13 on capital gains in the OECD and the UN models. So as Alexandra mentioned, there are different tax treaty risks in the extractive sector, and we're going to briefly cover our main recommendations included in the practice note in relation to each risk, starting by risk 1, the taxation of offshore indirect transfer of mining assets. Indeed, tax treaties may prevent source states from being able to tax profits coming from the sale of shares in mining assets that are located in their country. How? So let's see this case. So this is the Her Majesty the Queen Canada versus Mill Investments case. Basically, we have here Mr. B, who is a resident of Monaco and acquired a 29.4% shareholding in Diamond Field Resources, which is a Canadian company engaged in mining exploration. So what happened is that in 1993, Mr. B transferred his shares in DFR to Mill Investments, which is a company in the Cayman Islands, wholly owned by Mr. B as well. And then 2 years after, Mill Investment exchanged shares of DFR for shares of Inco Limited, another company in Canada, leaving Mill Investments with less than 10% of DFR, of the Diamond Field Resources Company. And then Mr. B moved Mill Investments from the Cayman Islands to Luxembourg, which actually has a treaty with Canada that exempts capital gains tax for the source state. So what is interesting here is that in 1996, just after that redomiciliation, Inco purchased Mill Investments' remaining shares in DFR. So in consequence, what happened is that Mill Investments realized a gain of 425 million CAD for its shares, which according to Mill was exempt from the Canadian tax under the treaty between Canada and Luxembourg. And the Canadian Revenue Agency argued that the benefit obtained by Mill Investments was an abuse of the treaty that should be disallowed under the Canadian General Anti-Avoidance Rule. However, the court found that there was no evidence of abuse. It was clear that Mill's gain was exempt from tax under the treaty between Canada and Luxembourg. So in this case, the treaty between Luxembourg and Canada basically prevented Canada from being able to tax profits from the sale of shares in mining assets located there in Canada. And the case shows how likely it is that indirect transfer of mining assets will generate considerable capital gains, right? As this case, and as Alexandra mentioned before, you will see in the practice note all the relevant cases on this topic involving millions and millions of dollars. And here as well, it's important to highlight that the ability to tax indirect transfers depends on Article 6, income from immovable property in the treaty, right? If the definition is too narrow, the resource-rich country may miss out to tax, significant tax revenue. And we will see this in a few minutes in detail. Also important to highlight that the toolkit on the taxation of offshore indirect transfers by the Platform for Collaboration on Tax already identified that only 35% of treaties include the right to tax indirect transfers, and only 29% when one party is a low-income, resource-rich country. Now, how can resource-rich countries address these risks? So we think that first, countries should make sure to provide a comprehensive definition of immovable property in their domestic law. For our colleagues joining today from tax administrations and ministries of finance, you know that Article 15 of the OECD and the UN model says that the source state can only tax offshore indirect transfers if the underlying asset or right is considered immovable property. And then if we go to Article 6, that term immovable property is given the meaning that it has under the domestic law of the state where the property is situated, right? So it is critical, it's very important that resource-rich countries have a comprehensive definition of immovable property in their domestic law. Second, we think that countries must make sure that the right to tax indirect transfers exists in their domestic law. As we know, a tax treaty cannot create the right to tax indirect transfer, right? So countries must decide between, as many of we know, between two models to introduce this right in the domestic law. You know, there is model 1, which taxes the indirect transfer as if a direct sale of assets had occurred in their jurisdiction. Then there is model 2, which taxes a non-resident seller on the transfer of shares or comparable interest in a company that is located in the source state. Some countries may decide basically for the combination of these two models with different thresholds. But what is important here is to establish the right to tax indirect transfer in the domestic law. Third, once resource-rich countries have established the right to tax indirect transfers in the domestic law, we think that they should maintain this right in their tax treaties. Otherwise, they open themselves up to the risk of treaty shopping. And this can be achieved through two ways, through Article 13, but also through a standalone extractive industry article. So you negotiate Article 15, including paragraph 4, which includes the right to tax indirect sales or transfer of mining assets. So you need to make sure here, for example, that the source state has the right to tax gains from the sale of shares, but not only shares, but also comparable interests, which are quite important for mining, considering the important presence of partnerships, for example, or joint ventures. It is interesting to share that from our survey, only 60% of the sample treaties included shares and other similar rights or interests. Also, when you negotiate Article 15, you should establish a sourcing rule of at least 50% as established in the OECD and the UN model. And lastly, you need to make sure as well that the period during which the shares derive their value from this immovable property in the source state can be at any time during the 365 days prior to the sale, prior to the alienation. So that's one way, negotiating through Article 15. But the other option is to negotiate a standalone extractive industry article. And some countries have done that. And what's the benefit of this? The benefit of a standalone article is that it includes an explicit reference to the indirect transfer of extractive assets. Even they include sometimes the definitions of exploration, of exploitation rights. And given that this is a standalone extractive industries article that is already a huge deviation from the OECD and the UN models, countries also may find it easier to negotiate a lower sourcing role for the indirect transfer of mining assets, right? Lower than the 50% that is included in the OECD and the UN model. So this is about the first risk. And we also think that, and this is one of our main recommendations as well in the practice note, is that countries should adopt an exhaustive definition of immovable property. So the first question here to ask ourselves is why immovable property is important for mining, and there are basically two reasons. The first reason, and I already mentioned this a little bit, is the ability of the resource-rich country to collect capital gains from the transfer of mining or exploration license as well, which relies on the definition of immovable property in the domestic law, right? And the second reason is that Article 6 on immovable property is also a backstop to Article 5 if the resource-rich country is unable to prove that extractive activities can trigger a permanent establishment. And then after this, the question is, so then what risk should resource-rich countries should consider when defining this immovable property? So if we go to Article 6 again of the OECD and the UN models, the definition of immovable property depends on the domestic law, as we already mentioned. Regardless, it lists a number of assets, a number of rights that should be considered immovable property. And this list is quite limited, I would say. This list includes rights to variable or fixed payments as consideration for the working of the resource. So then the problem here is really that the OECD and the UN definition of working a resource does not cover rights, for example, to exploration. It does not cover depreciable assets. It does not cover non-public information. Why? Because working a resource is defined as a means to remove the resource from the landed property. This means that resource-rich countries should be able to tax income arising from extraction, but not from exploration activities or depreciable assets, for example. It is interesting to highlight as well that from our survey, only 4% of sample tax treaties include the right to explore in the definition of immovable property in Article 6. In addition, and very quickly, the scope of Article 6 has been discussed at the level of courts. In the case Royal Bank of Canada versus HMRC, which is the British Tax Authority, the court discussed basically what are the limits of the scope of Article 6, paragraph 2 of the UK and the Canada Tax Treaty. The court said that there was no reason to limit the scope of Article 6, paragraph 2 of the treaty to cover only payments that are made directly to the owner of the extractive right, provided that the payments were related to the immovable property that is located in the UK, right? And here we're talking about a Canadian bank that received royalty payments from an oil company operated in the UK, and in this case, the HMRC collected over 12 million in tax. So how can resource-rich countries basically address these risks? Well, first of all, resource-rich countries need to, again, require and provide a robust definition of immovable property in their domestic law, which include exploration assets or rights as immovable property. And we would suggest that to avoid any ambiguity, what countries need to do is to clarify in their domestic law that immovable property covers both the right to exploit, the right to mine, but also the right to explore. And then also some countries may choose to adopt an even broader domestic law definition of immovable property that includes also payments calculated as reference to the value of mineral production. And very quickly, there are multiple ways to derive income from mineral deposits that are not limited to the right to explore, to the right to mine, such as what we call royalty financing arrangements. So these are financing mechanisms in the mining sector, also in the oil sector, that gives the lender, the financier, the right to a production royalty in return for an upfront payment to the mine. So these arrangements are becoming very, very common in the mining sector, and makes it important for resource-rich countries as well to consider adopting a broad definition, such as Canada does, for instance. And lastly, it is important as well to specify that the right or the asset is situated where the immovable property is located. And this is quite common in Australian tax treaties. What does is that it puts beyond doubt that income from the sale of mining or exploration rights is subject to tax in Australia, which, as I already explained, is very, very relevant where the right is indirectly owned and potentially sold by a foreign company. So I will stop there and I will pass on to you, Ali.
Thanks very much, Jacqueline. If I can go to the next slide. I'll try and keep these final remarks brief because we want to hear from our other esteemed panelists. So the third risk that we identified, you may recall, was taxation of subcontractors. So what is a permanent establishment? And we talk about this concept in tax treaties. A permanent establishment essentially means you have a taxable presence in the source country, so in the country where the mine is located. So typically, you will have a permanent establishment if you have a fixed place of business, and so you're there. That means that you're there for a period of time. It means you have a fixed location. There are other rules that need to be met, but this is the primary one, I think, for our purposes today. So the profits of a non-resident entity will only be taxable in the source country if they have a fixed place of business. And that means then that they have a permanent establishment, a taxable presence in the source country. So a mine site is typically going to satisfy the conditions for permanent establishments. So it's in a specific location. A mine site is going to take many years to construct and develop. So in most cases, if a non-resident entity has a mine in the source country, it will have a taxable presence, it will have a permanent establishment. Where it becomes less clear, however, is in the case of subcontractors. So this might be mining services companies that come in for a period of time to offer, engineering services. They might operate certain equipment, undertake very kind of particular functions for the mining operation. And because they're more mobile than, say, the mine, which is in a fixed location, it's much easier for those subcontractors to structure, to fragment their activities in a way that avoids triggering a permanent establishment. So if the time threshold, for example, for having a permanent establishment in the source country is 6 months, so meaning you have to be operating in the country for 6 months, subcontractors, it might be easier for them to break up their activities, so they come in for 3 months at a time, and then they leave again, they come in for 3 months again, and so they never have a taxable presence in the source country. And this is significant because there's huge sums of money that are going through subcontractors in this sector. A really important report from the Natural Resource Governance Institute suggested that there was something like $1 trillion industry in extractive industry subcontractors. So there's big money here, and I think more and more as we go forward with the improvements in technology in the sector, we'll start to see a growing presence of subcontractors. The other one that raises questions for permanent establishment is remote mining operations. So the mine of the future, where someone sitting in London is operating a mine using a joystick, and there's no physical presence in the country. So in that case, will you have a permanent establishment? Will you have a taxable presence? Will the source country have the right to tax the income earned from providing those services? So that's what permanent establishment is. I think for a mine, it's generally satisfied, but subcontractors, remote mining, are the areas where there are kind of question marks. The next slide, thank you, Jacqueline. So what are the risks here? As I said, the key risks that we're trying to solve for when designing permanent establishment provisions in treaties for resource-rich countries is the right to tax subcontractors, which are more mobile than license holders, and dealing with the question of remote mining operations, so where the services companies and so on don't have a physical presence. This is a very complicated area, I think, for tax treaties, and I think the issue of remote mining operations is certainly a challenge and a question for countries to consider. Probably the best option to deal with this particular issue at the moment, however, is to adopt Article 12A of the United Nations model, which allows countries to charge withholding tax on payments for technical services provided by non-residents. So under that article, there's no requirement for the non-resident subcontractor to have a permanent establishment. So it doesn't matter that the services are being provided remotely, provided there is a connection between those services and the mine, which is located in the source country. The source country should be able to at least charge a withholding tax on gross revenue earned by that non-resident subcontractor. So Article 12A of the UN model is probably the best option for countries at the moment to address the particular issue of remote mining operations. More broadly, however, in terms of permanent establishment in the extractive sector, at a minimum, it's necessary to have a reference to mining activities in Article 5, Paragraph 2, which is essentially an illustrative list of the types of activities that will have a permanent establishment in the source country. But that is a minimum. That should be the basic level that all resource-rich countries have in their treaties. Beyond that, there's a few options to choose from. The preferred option, or the option that provides the most coverage to resource-rich countries, is the option that Jacqueline mentioned in relation to offshore indirect transfers, which is to deem a permanent establishment to exist in a standalone extractive industries article. So this is a separate, unique article in the treaty specifically for the extractive industries that can set lower thresholds for triggering a permanent establishment, so a lower time threshold and so on, that is going to be provide a much faster taxing right for the source country. Other options are to deem a permanent establishment to exist for extractive industry activities in Article 5, which is the article on permanent establishment. So this is an alternative. It's more consistent with the OECD and UN models, so it might be easier to negotiate with treaty partners. However, the limitation is that it's potentially less comprehensive than having a standalone, a separate article. And then the last option is to include a reference to mining activities in Article 5.3. So I won't go into more detail because we're short on time, but at a minimum, having a reference to mining activities in the illustrative list in Article 5, and then ideally having a standalone extractive industries article or deeming a permanent establishment to exist in the Article 5 on permanent establishment. The last topic, moving to the next slide, the last topic is on retaining the right to tax income from management and technical services. So we said this is very important because we see huge amount of technical management services coming in from abroad to the mine in your country, and you quite rightly, as a resource-rich country, would like to tax some of the income from those services. So this is a case here of Paladin Energy in Malawi. So this is where Paladin is operating a mine in Malawi. They made use of a tax treaty between Malawi and the Netherlands that exempted withholding tax on services income. And so they were able to avoid paying any withholding tax on that income. And then that income was routed from the Netherlands through to the parent company in Australia. So this was a very clear case of treaty shopping, taking advantage of the low or zero rate of withholding tax in this case in the treaty to avoid paying any tax in Malawi, and then being able to transfer that, effectively stripping profit out of the mine via the treaty and transferring it to the parent in Australia. Moving to the final slide here. So this is a significant issue for the sector, as I said, a major source of outbound payments. Countries that relinquish the right to tax these fees often will forego revenue, but they also increase the risk of profit shifting in response to lower rates of withholding tax. Our recommendations are first and foremost to adopt a standalone fees for technical services article. So this is Article 12A of the UN model. As I said, this will allow source states to tax non-residents irrespective of whether they have a physical presence, which is important if we're thinking about subcontractors and so on that are able to more easily avoid having a physical presence in the country. To alternatively to expand Article 12, which covers royalties, not mineral royalties, but rather royalties for intellectual property, for the use of equipment, to include technical fees there. However, that's not necessarily going to be the best option because it's going to be very limited as to what types of activities will constitute technical services under Article 12. And finally, to deem a permanent establishment in the case of extractive activities, or a permanent establishment in the case of provision of services in Article 5. So those are some of the options there. As we said in the chat, these are explored in much greater detail in our practice note, which you have the link to. But I think just to conclude, the message from us is that it's important for resource-rich countries to firstly consider the costs and benefits of entering into tax treaties, whether it makes sense given your circumstances, and if you are a resource-rich country, to consider that in the context of the mining sector. And if you choose to enter into a treaty because of some specificity in your jurisdiction, then to think about these 4 key areas that we've discussed today as being some of the most material risks to revenue arising from tax treaties, and the different options that are set out in the practice note based on the experience and the practice of other resource-rich countries as to how they've sought to address these issues so that they can better protect their right to tax mining income. So we hope it's a useful resource, and I hand back to you, Michael, so we can hear from our other panelists. Thanks very much.
Thank you, Ali, and thank you, Jacqueline. It will be a very useful resource. The language of tax treaties is a little bit quirky. The first rule of permanent establishments is that they need not be permanent. And so I don't get a lot of letters, I'll just mention that when I mentioned earlier the non-discrimination article is unusual in that it prevents non-discrimination, amongst other things, based on nationality. Residents, there's some ability to treat people differently based on residence. So that's one for the, it's an unusual provision, but I just wanted to clarify that. So with that, we're very lucky in our discussants, and you can put questions in chat while they're speaking, and we will come to them during our Q&A period, and maybe for some of them after they've spoken. The first discussant is Amadou Badiane, and he's the Director of Legislation and International Cooperation at the Senegalese Ministry of the Economy, Finances and of Planning. He will speak in French, so over to you, Amadou.
Merci, Michael. Bonjour.
Thank you very much. Thank you, IGF and your secretary, to have welcomed me today and invited me to speak and share our experience in Senegal on the taxation. So as my country has been helped by IGF, really want to thank them and thank IGF for their help and their support for our countries to really exploit all our resources and all the opportunities that we have. So thank you, Jacqueline and Ali, for your presentation as well. It really helps us to create the better model possible. So dear participants, Senegal is an African country. It's based on the western part of Africa. We worked a lot with zircon. We have gas that have been discovered in Senegal as well. It's a country that have seen tax treaties as an attractive aspect for partnerships and for some work. So this is why we have a lot of tax treaties, usually with developed countries such as France or Canada, in the Great Britain, Spain. We also worked with the Mauritius until 2019. So for those tax treaties, we saw that they were really at the basis of the base erosion and transfer shifting, even though there are a lot of work on that, and we also saw great things. But first of all, the first thing I want to share with you is that there were a misuse of those treaties only to do profit shifting or treaty shopping. And there was one treaty that really hurt us, and it was the one with the Mauritius, because it foreseen a misuse of residence, and for Australian, French, or Canadian companies that were working with us, and we had other treaties with them. If they were in the Mauritius, they could go there to avoid taxation on capital gains and royalties, and in the end, it leads to a great loss for us. So when we assess the mining companies from 2016 and 2018, there were more than $200 million of loss for us. So it was a really bad thing. And we saw that a Canadian company changed their residence to the Mauritius island, and they can flee, and they could avoid, they were able to avoid more than $8 million of taxes. So besides the Norwegian Convention, as Ali said, none of their treaties had a natural resources provision. And for the permanent establishment and the question of the subcontractors, we saw for oil and gas, there were also problems about time, because they were able to change the timing. So as you said, you fragmented it. Instead of 6 months, they started, for example, they were going to Morocco for a few months, and then they were going back for 3-4 months in order to avoid the threshold of 6 months, and we weren't able to trigger the permanent establishment. So we had the issue because we couldn't find the great provisions about that until 2017, and we also had some issues about some gains, and that they were avoiding all the taxes in our country. I think that Jacqueline pointed it out. I don't have to talk about this again, but Senegal really suffered great losses regarding these mines that were in Senegal. And Jacqueline talked also about another aspect, and it was services that weren't taxable in Senegal or captured because the presence wasn't fulfilled, and the criteria of the permanent establishment wasn't fulfilled here. So we have also a Malaysian and Portugal treaty with them for the technical services, such as we saw in the UN model. And so what were the answers from Senegal to face this issue? So first of all, I think that Jacqueline talked about that. It's to rethink the domestic law, because you don't have a taxable right all the time, but you need to have you need to strengthen your domestic law. Otherwise, you can't tax those in the best possible way. So our work was to review our domestic law, first of all, in the mining sector, especially with the tax administration and the experts. And at the moment in Senegal, for the besides VAT, we erase other aspects of taxation, and we straighten the mining sector with the indirect transfers, but adding also a solidarity aspect with if the lease or the sale is not stated in Senegal, you have to find it then, and you can tax it, and you need to disclose it. So we really changed our domestic law. In the end, we reviewed it, we renewed it as well. So thanks to the support of different platforms and different key actors such as IGF, ATAF, MFI, there are a lot of actors in that, and we integrated as well the technical services aspect based on the UN model, but it's important to highlight also the article related to natural resources, both inshore and offshore. It really helps the negotiation of the tax treaties. Otherwise, if we don't have it, we don't accept to negotiate a tax treaty now. And another really important point as well was that we always do an impact study before negotiating a tax treaty to be sure that Senegal will benefit from that, and also to protect our gas and oil resources. And we also made a statement about what happened with Mauritius, about all the BEPS related problem that we faced. But besides that, and even though we're doing a lot, it's also fair to say that we're still facing some issues, and there's still issues arising, because it's really hard to negotiate and renegotiate those treaties. There are politic things at stakes. There are always consequences about that. And there is only one or maybe two treaties in which we were able to renegotiate and add those articles and those provisions. It's really hard to do so, even though I think it's one of the most important points. And I really hope that IGF and some other partners will be able to help us in that and help us say that we need those. And another point as well to ensure the striving of our economy is Pillar 2 with the 15% and the tax institutions for future tax treaties, because it's really important to know that if some measures are not put into force, the countries will ask for help related to this Pillar 2 and its coexistence with the tax incitations provisions. And if such thing is not made quickly, Pillar 2 will benefit more to countries that are doing business with us rather than our countries that are resource-rich countries. So thank you, Mr. Michael. That was what I wanted to share about our experience in Senegal, and I'll be very happy to answer your questions also. Thank you very much.
Thank you, Amadou, and very happy to hear you do an impact assessment. They're not easy to do with treaties, knowing what the uptake will be and what the costs will be over time, but it's something that is it's very important to try to get a sense of what that is, and more to look at the impact in relation to all your other obligations, including your investment agreements. I don't think there's any questions we have to ask you at the moment. We'll keep those to later. So I think for the moment on that approach and coming back to you later on those questions, we'll pass to Carlos Proto. And Carlos is the Director of International Tax Relations at the Ministry of the Treasury in Argentina. And he's also a member of the UN Tax Committee, I should say, and he will speak in English. Carlos.
Thank you, Michael. Thank you, IGF, for organizing this webinar, which is quite useful, and also for launching the practical note on tax-based protection through tax treaties. It's something that I really welcome, and I hope it is useful for all tax treaty negotiators and tax policymakers in order to design a better tax system to protect themselves and also raise revenues. Thank you for the presentation. We have seen a couple of minutes ago, because it highlighted the risk that some resource-rich countries may face at the time of signing or concluding a tax treaty. Before going to that, and also repeating what Michael has said about tax treaties, that they allocate taxing right among states, while those states are sovereign to introduce or levy taxes according to what they consider is the best for them. So states are sovereign to levy taxes on whatever they want, in particular the revenue or the income obtention. So taking that into account and noting that tax treaties may reduce the sovereign taxing right of one particular state, I will highlight some issues for tax policymakers to take into account at the time of designing their treaty model, according to which they will enter into negotiations with other states. So, as you may know, tax treaties allocate taxing rights in order to tax income derived through business activities, business profits, I may say, as Alexandra has indicated, if there is a permanent establishment to which the income is allocated in the state where the activities are performed. So in the absence of that permanent establishment, there is no taxable presence and there is no taxing no tax at all in the state where the mine could be located or any other extractive activity is taking place. So it is important, though, to have a broad definition of a permanent establishment. What a permanent establishment means: it is a fixed place of business where the activities generating the income are taking place. So we need to define that fixed place of business in a way that it allows taxation to the state of source in most scenarios, in order to protect that income that is being generated through the exploitation of the natural resources in the land. So one recommendation is to have a broad definition of permanent establishment. It could be in general terms or specific to natural resources activities. One recommendation is to shorten the threshold in terms of time, not going through the 6 months as it is commonly understood in tax treaty practice, but it could go to a shorter period of time. It could be 1 month, 2 months, 3 months. That would be my recommendation, to limit the period of time that is required for a permanent establishment to exist. So that's for activities taking place in the land. If there is no place or fixed place of business, I also recommend to follow the UN model in Articles 5.3b. That means the service PE, the permanent establishment for the rendering of services. You don't need to be in the same place all the time, but you need to perform activities in the form of services for more than a specific period of time. The model says 6 months. Again, and just for natural resources, my recommendation is to shorten that period of time. So the performance of activity or of services in the state of where the natural resources is located could be shortened to 1 month, 2 months, or 3 months, wherever you may decide. And as Alexandra has also indicated, some services don't even require any physical presence of the service provider in the land. So you can introduce an article, a specific article addressing with those type of services. It could be technical services in the definition of royalties, like some Latin American country has already done, or you can follow Article 12A of the UN Model Tax Convention that allocates taxing right to the state of source for the income derived from technical assistance in cases where there is physical presence, but also in cases where there is no such physical presence. So you keep your taxing right for those cases as well. And again, you can introduce no need of any period of time there, because you don't even need a presence. So you can tax that, and you can limit that taxation in those cases. Another risk that has been highlighted is related to capital gains. I won't expand so much on that, but please follow the UN last recommendation according to the modifications introduced in Article 13 that allows the indirect transfer or capital gains on indirect transfers, in particular of shares. Shares of mining companies is something that reduces the tax base, because according to the standards or the previous standard in the models, there was no taxing right allocated to the state where the company which is sold is incorporated. Now you can fix that by keeping some taxing right if the underlying assets of that company are located in the place where the natural resources activities are taking place. You can keep that taxing right, and you will tax the proportion of the capital gain derived by the alienation of that share that corresponds to the assets that are located in the land. For that, you need a domestic legislation that creates that taxing right. So please not only have a good tax treaty policy, but also be assured that your domestic legislation could be applicable in those cases. There is not so many guidance on how to introduce that domestic legislation, but you can visit some legislation, in particular in Argentina. We do have something that could help you if you are interested. And finally, something that has not been highlighted is related to base erosion that can take place through excessive deductions of interest in many finance structurings that could also take place among companies in the mining sector. So according to the standards, both UN and OECD models, the state of source has a limited taxing right with regard taxation of income in the form of interest. In those cases, my recommendation is to have a definition of interest that relies in domestic legislation in a way that you can apply any general anti-avoidance rule, like any substance over form rule that may allow you to determine whether a payment could be characterized as an interest because it is remunerating the loan or something in a financial structure. And you may also make a link in order to the limitation in your taxing right only to the portion of the payment that reflects the arm's length principle. As you may know, the tax conventions, most of them follow the arm's length principle. That means that income are allocated to enterprises following what could have been the income derived by a third party when you are analyzing a control transaction that take place among related parties. So in order to avoid base erosion through manipulation of the transfer pricing according to which transactions among related parties take place, you can compare that price according to what has been concluded by independent parties in an uncontrolled transaction. So if you are going to limit your taxing right regarding interest, because that's the practice, interest should be taxed, but that taxation should not exceed at least, let's say, 10%, 12%, 15%. Okay, if you are going to limit your implementation of taxing rights to those interests only to that proportion, that 15%, for instance, you may guarantee that you're only limiting on the portion of the payment that is related to the arm's length principle, being the excess, the base erosion, subject to tax according to domestic legislation. That means that there is no limitation at all. And that's something that may be relevant for in countries that are natural resources rich, because you may avoid base erosion and profit shifting in those cases. A final comment, all these tax treaty policy and domestic legislation tax policy will be useless if you don't allocate some resources to the audit team. You need to detect whether there is a treaty shopping activity, whether there is a taxing right that should be implemented in your state, but it is not what the taxpayer has declared in its tax return. So you need to detect what's going on, whether to find out if you are collecting taxes as designed. So it will be useless to have a very protective tax base in a tax treaty policy if you are not searching for those taxpayers trying to circumvent or to avoid the exact portion of taxes that they should pay. That's my final comment. Thank you for this opportunity to share with you my views, and I'm happy to answer any question you may have. Thank you.
Thank you, Carlos. I think what we'll do, we'll go to the last speaker and then we'll have a round of quick answers to the questions that have been raised. So I'd ask all discussants to look at those questions and we can do a round of quick fire answers, quick but accurate answers. So before that, I'll go to our last discussant. This is Tugsa Serenen Dorj from the head. She's the head of the Dutch Taxpayers Unit office, the large taxpayers office of the General Department of Taxation in Mongolia. And she has the rare distinction that she's worked both in tax and treaties at a high level, which is a very valuable complementary set of skills. Tugsa will speak in Mongolian, so most of us will need to go to the translation, interpretation. Tugsa, over to you. Thank you.
Баярлалаа, Michael.
Thank you, Michael, and thank you for thank you all for giving this opportunity to me for sharing my experience. So today we will talk about the issues related to our practice of what needs to be bear in mind by other countries in terms of implementation. So and what could be the impact of the double tax treaties. So and how we have been that has been interacted with the big stabilization agreement, and what were the consequences of that double tax treaty, which was stabilized under the stabilization agreement by a big mining player. So so this is in terms of extractive industry, it is really important to attract the foreign investment. So for this reason, we have signed several so for many countries have stabilization agreements and also double tax treaties, and we had so in the early 2000s we started to implement we've started to implement stabilization agreement with the big double tax treaties. But what it has led to today is what with the so at the international level, big mining corporations. So we have already suffered some negative consequences of these double tax treaties when it interacted with the stabilization agreement signed by a big multinational enterprise. So and so most double tax treaties were signed, established over 40 years ago. So at that time, we lacked the capacity and knowledge, and we didn't have experience. We hadn't even started the mining operations by then. So and so the domestic laws and also the double tax treaties had lots of gaps, and we didn't have any sufficient the clauses and articles that would protect the taxing rights. And so and at that point, big mining player and had established a stabilization agreement with the Mongolian government. So what happened is that so not only the stabilization agreement, as a source country, for us, most of the tax types and the tax, and that covered all types of technical and management service fees, and also the major projects we also dependent on the financing, external financing, because Mongolia, most of the mining companies have financings and financial transactions, and in the so it means that there is all the payments. There is a quite wide range of outbound payments. So it so the double tax treaties provided some credits, discussions, stabilize. So as a result, Mongolia as a right to tax has extensively limited. So and as a result, as a consequence of the stabilization agreement, the stabilized also the double tax treaty. The company had that. So and there isn't. We have the estimate that a recent tax audit, we identified huge 900 deficiency of 900 million USD of financial transactions, and we imposed the additional tax of tax cap of 100 million for a period of couple of years. So this means that there is a huge consequence. So, and also there is a technical, most of the investors are either from China or Australia or from Canada, and in terms of technical fees, technical services fee, so there was a stabilization of the technical fee payment and double tax treaty for many years, and that also caused base erosion for Mongolia. So internationally, the tax rates and so there internationally, when we analyze the international level, so there is a very few, almost none cases where this stabilization clauses, stabilization agreements stabilize not only the tax types but also tax rates, and including the tax treaties. So, and also, and if there are any, they are very short term. So, but in our case, that was a long term. For over a period of 60 or 50, as long as 60 or 50 years. So that's that was a very unique case for Mongolia. This case of stabilizing the double tax treaty is limiting the sovereign right of the country to adapt its domestic laws. So, and we regard that this is a big risk for a country, because the time is changing. 50 and 60 years stabilization is disregarding the economic development and the economic rapid changes that are taking place today. But the BEPS action plans have advanced, very sophisticated, but we are stuck by the stabilization clauses, because the stabilization clauses are holding us back, from the opportunity to. So we are limiting it's impacting our opportunity to change our policies and also improve the domestic laws. So. So this is the circumstance that occurred in Mongolia. So by this investment agreement, what we are doing is 2014. So we concluded that there will have been a treaty shopping and there is opening. So, and we abolished 4 double tax treaties on unilateral initiatives. So, and at that time, we had, even if we had abolished, canceled these double tax treatments, the investor is still insisting and applying the already abolished double tax treaty, because they claim that they have stabilized the clauses of the double tax treaties for a period of 50 or 60 years. So that's, you can imagine what would be the consequence in terms of tax-based erosion and in terms of the treaty shopping. So, and that is not only limiting the taxing rights, but also limiting our opportunity to change and improve the domestic laws, apply the changes in the domestic laws. So, and with this lesson learned, I would like to recommend that so there should be very thorough consideration for the consequence, and lessons should be learned from our experience, how it's important to be cautious when negotiating a double tax treaty, and not to be in a circumstance like us where. So, and that also covers all potential types of tax incomes, including the capital gains, and it means that we are largely dependent on the stability clause and stuck in the time of the tax conditions 20 years ago. So this is the big lesson that we have learned from our practice, and I would like other countries to take lessons and also please bear in mind our experience when signing, negotiating a double tax treaty and implementing, administrating such treaties, and also how it interacts with the stabilization clauses. So if the stabilization clauses, if you have to establish stabilization clauses, please, you should bear in mind that at least the term should be not long enough, as in our case. Thank you.
Thank you, Tugsa. We'll go on for a few minutes beyond the scheduled end time, and I'll be keeping my concluding comments very soon, very short, so we can answer some of these questions. So I think I'll go straight to the question, and I'll ask for brief responses. We have one from Catherine Chalima, which basically is saying, what if a country refuses to include Article 12A or something similar, UN Article 12A, on fees for technical services, but it's important to you? I know some countries have said this is something that our government requires. We can't enter into negotiations without that. But I'll pass to one of our expert treaty negotiators to talk about that. Carlos, do you have any views on that?
Yeah, thank you, Michael, and thank you, Catherine, for this question. And that's crucial question, because it's not only related to Article 12A, but is something that we need to keep into account at the time of concluding a tax treaty in all the tax policies that are relevant for us. So it could be the definition of service PE, or the inclusion of some specific income within the definition of royalty in Article 12. That's are the key issues at the time of negotiating. What you can do is just to say, okay, this is an important provision for us, and check with your political level whether you can say there is no tax treaty if we don't include that policy. For that you need to clear with all the different stakeholders in your government that you can be stuck to that policy. Otherwise, you will lose negotiating powers if you start giving up to what is the request of other countries. Even though they say that there is a lot of investment that will flow to your jurisdiction after the conclusion of the tax treaty, and you will be pressed by different governmental areas to conclude the tax treaty, you need to be clear with your political level that it is an ultimate position from your side, and you need to balance which is the most interested party in the conclusion of that tax treaty. Have your jurisdiction been the one requesting for the conclusion of that tax treaty, or it has been the other way around? It's normally the developed countries that ask developing countries to conclude a tax treaty because they need the protection for their investors when they invest in your jurisdiction. So you need to know that. And our recommendation is to be consistent. You cannot keep Article 12A in one article, but then giving up in the following tax treaty that you may conclude. So my recommendation is clear with your politician that you can keep your policy regardless all the threats you may receive from the other side. And second, to be consistent alongside your treaty network, and also think whether you need to renegotiate all those tax treaties that don't include that policy. For instance, past tax treaties that don't include Article 12A, you can ask for a renegotiation of that tax treaty just to include that provision, noting that you will be asked for something in exchange. But that's my recommendation. Probably others may have other views. Thank you.
Thank you, Carlos. I'll move to another question, but the discussants, if they want to add to that in answering other questions, feel free to. There's a question from Donald Idet, tax expenditure or tax revenue forgone. As a practical matter, do such calculations take place during negotiations. And I think I might call upon Amadou if he's got any comments on that, because you do an impact assessment, which was good to hear. So Amadou, in first instance, do you have any comments on that?
Merci, Michael.
Thank you very much, Michael. Yes, actually, tax expenditures are a key aspect of the mining regulation in our country. If we take Senegal, for example, a few years ago, we had an exception 3 years from the investment. It's the same as maybe inviting someone home to have dinner and then paying for them the taxi to go back to their home. So I think that the solution in the end, if we really want to protect our tax base, is to rationalize those, and it's something that we've done. There is no tax holiday for the exploration and exploitation, sorry, and all the aspects that can't damage the exploitation aspect. So that's what I can say on tax expenditures. There are a lot of guidelines on that. There is a platform that really helped us. IGF developed a lot of guidelines on this matter as well, so I refer to those. And the other point is renegotiation, and it's quite a tough one. I have to admit, we started to renegotiate it, and we had to say that there was an issue with a negotiation with a treaty, sorry, because one of their counterpart was quite slow and not really willing to renegotiate it. So we had to say there is an issue here. Obviously, it's not a good thing for the relationships, the economical relationship with other countries. But in the end, we know that if we need to say that there is an issue about the renegotiation. We need to go forward about that. Thank you.
Thank you, Amadou. And Carlos, did you have any other short comment to add to that? I know this is an issue of interest to you.
Yes, thank you, Michael, and thank you, Amadou, for your comment. I totally agree with you. Regarding tax expenditures, you need to make an impact assessment whenever you start or you think about concluding a new tax treaty. You need to know what the new tax treaty will look like, what will be the tax losses that you may now collect at the time that tax treaty may enter into effect. Secondly, and regarding the mining sector and what could have been any other stabilization clause in any domestic legislation or another treaty, you may already know what are the tax expenditures, what taxes you are not collecting because of that specific preferential regime you are granting to the mining activities. So everything has to be into account at the time of deciding any different tax policy, including the one of concluding a tax treaty. And finally, and complementing what Amadou has just said on how likely it is for a tax treaty to be terminated, that is the last resort. I don't recommend it, but it's still available. If your counterpart denies to renegotiate something that is important for your jurisdiction, being linked to the natural resources sector or not, if it is important for your jurisdiction, you ask for a change in the treaty and you are rejected, the last resort is to terminate that tax treaty. And again, you need to know who could be harmed by that decision, who has been the one requested to have that tax treaty. If you are the state of source, you are giving up on your taxing rights and you are not collecting what you were expecting because of that tax treaty, you can terminate it because the impact will not be to you. Okay, it may affect investment in the future, but you will have the counterpart asking to you to renegotiate a new tax treaty, and then the new tax treaty will solve that problem. That's my views. Argentina has terminated some tax treaties in the past, at least 4 of them in the last 15 years. It's not my recommendation, but it's still a resource. Thank you.
Thank you, Carlos. I'll ask the next question. I'll actually add 2 questions together and pass them to Ali and Jacqueline in the first instance. And the first question is from Donald Ide, and it's effectively saying the issue about resource countries asking for some processing to take place in country. Would it help to ask, or would it help to maybe suggest resource countries demand or consider this? So effectively, should resource countries be demanding as part of this process, which I think is an important issue, or some other process, the processing to occur in country? And I'll add a second question, which looks related. When are we going to best adapt mining tax incentives for mining investors during the mining cycle, especially for a non-resident company? I see that Ali is typing an answer to that. So maybe if you could answer those 2 questions. That one is from Redmi 10X 4G. Thank you. Ali in the first instance.
Thanks, Michael. And thank you for the questions. So very briefly, I think thank you, Donald, the issue of processing. I think it's important that countries look at ways to increase value addition in their country. So to keep more of the mining value chain in country rather than seeing the majority of your minerals exported in their raw form elsewhere for further processing, further beneficiation, because that means that the host country, the country where the resource is located, loses out on some of the additional value that's created in that process. So it's certainly advantageous to countries to try and encourage investors to do more of the processing in country. However, that needs to be considered. There needs to be careful cost-benefit analysis undertaken as to whether or not that's actually feasible for the investor to do that. It'll depend on the availability of electricity, of water, and so on, and whether those things are available to enable further processing in country, and whether they're available at a cost that countries can afford. That investors can afford. So this is just, it's a careful kind of cost-benefit analysis that needs to be undertaken as to whether it makes sense to bring processing onshore into the resource-rich country. I think it's certainly an important aspiration and ambition, but it will depend whether it's actually economically viable for the investor. Depends on that analysis that needs to be undertaken by government and the investor. And then there's ways, linking to the question about incentives. I think, Redmi, I will refer you to our guidance on mining tax incentives in the chat. You might want to review that, but certainly looking at the ways you can design fiscal terms to potentially encourage processing to take place in your country. So by perhaps allowing some form of investment credit for construction of processing facilities, these sorts of things can be ways of also reducing the cost to investors of bringing those processing activities onshore. Thanks, Michael.
Thank you very much. There is a question about the tax base in offshore indirect transfers. It's a very complex topic. It is something in our UN handbook. There's something in the platform for collaboration on tax toolkit. But I understand there will shortly be an IGF OECD note, and I'm told that tax base will be quite an important part of that. So hopefully that question will be answered at that point. It is a complex area, but an important area, the administration of legislation to deal with offshore indirect transfers, which is allowed by the treaty. You need the legislation. You can't just rely on the treaty to give you a right. I think we have one other question that I can see at least. Does any element of the multilateral instrument address the issue of non-taxation in the extractive industries of developing countries? And I'll pass that first to Jacqueline, but I know Carlos has been very heavily engaged in negotiating some of these instruments or working with some of these instruments. So in the first instance, Jacqueline and then Carlos, and then I'll end by asking if Tugsa or Amadou have any further comments they want to make on any points, and then I'll make the briefest possible summation. Over to you, Jacqueline.
Thanks for the question. The short answer is yes, the MLI help a bit, but most of it's voluntary. So developing countries may have some difficulties in negotiating. By voluntary, I mean most of the MLI articles are related, are not minimum standards. So as we know, only the articles classified as minimum standards will automatically apply. For example, just to mention one risk, the risk related to offshore indirect transfers, the right to tax offshore indirect transfers for source countries. This is related to Article 9 of the MLI. However, Article 9, and it's not a minimum standard. In that sense, I think our main recommendation would be to consider what are the costs, what are the benefits of signing an MLI, the MLI, whether countries decide to address the risk of treaty abuse and other BEPS issues by renegotiating bilaterally or by signing the MLI, I think will depend on its situation, on its country situation, and also the positions of its treaty partners. Thanks, Michael.
Thank you very much. Carlos, did you have anything to add to that?
Yes, probably. Thank you, Michael, and thank you, Jacqueline, for answering that very interesting question. As you know, as indicated by Jacqueline, Action 15 of the BEPS project was not a minimum standard. That means that signing the MLI was not a condition for being an inclusive framework member or any interested party. You could sign it if you want, and if you didn't, you were not obliged. Secondly, if you have subscribed the MLI, you will see that there are different articles. Some of them, as Jacqueline has indicated, reflect the minimum standard of the BEPS project, while others are merely optative provisions. Those related to Action 7, which is a means of protecting the tax base regarding the status of the permanent established concept, those were optional. You could implement that recommendations by opting in for those provisions, but it depends on the counterparts to the different covered tax agreements that may be changed or modified by the MLI. So depending on the elections of other counterparts, your specific covered tax agreement, double tax agreement, will be modified or not, because that's not a minimum standard. So the concept of permanent establishment address different cases of avoidance in the case of fragmentation of activities that are now taking place in different places of businesses and not in only one as before, or the splitting up of contracts where an activity is performed by not the same person in the same contract, but by different persons according to different contracts. So those manipulations are now addressed by the different standards in Article 5 that are included in the MLI. But as I said before, it is not an obligation for every state to pick up that option in the MLI. Secondly, an important issue is the tax treaty abuse. Because Action 6 of the BEPS project was a minimum standard, so it is for all the members signing the MLI to modify their tax treaties, whether to include a main purpose test provision in their covered tax agreement or a robust limitation of benefits provision, which is a kind of objective criteria to determine under which circumstances the tax treaty benefits could be granted to any different taxpayers. Those are an important issue. They allow tax administration to counteract tax evasion through treaty shopping, and those provisions will be included in all the covered tax agreement at the time you have ratified the MLI. Thank you.
Thank you, Carlos. Tugsa, did you have any comments on any of those, quick comments on any of those questions? No, I think you're good, but if you do want to, just let me know. And Amadou, did you have any final comments? Any final comments from either Amadou or Tulsa?
Minute,
I'll go to
Excuse me?
Tulsa first.
For me, I have one comment. So for Mongolia, in terms of MLI, the domestic law, we have improved many clauses, to make it consistent with the international tax legislation. So before we had a very limited definition of the permanent establishment. So we have improved the domestic law definition of the permanent establishment. So, and if we we would benefit. We see that the MLI as a big opportunity to apply. So as long as the domestic legislation is good enough, the MLI would open door to improve many of the issues that were so for very few agreements we have Article 12A, but if we if we join the MLI, if we implement the MLI, we would universally apply. The effect would also apply and result in improvement and the rest of the agreements that we lack the Article 12A. So so under BEPS program, we have very well improved our domestic law. So and we see the MLI as an opportunity going forward. So we understand this is we would benefit very well from the MLI.
Thank you very much. Amadou, any final brief comment?
Merci, Michael.
Yes, thank you, Michael. I think that this conversation was very fruitful for everybody. I just want to say a question, a call for action for all the resource countries to add it to the inclusive framework of the UN, to have a coalition and have a strength, politically speaking, for our country to better protect and preserve our natural resources, as they can't be renewable for a very long time. So my last words are just this call for action and for protection. Thank you.
Thank you very much. My concluding comments will be very short and will follow on from what Amadou has just said. You have a lot of common interests. You should work together to make sure those interests are reflected in any bilateral, any multilateral work. And you should be demanding of us in the UN, of the inclusive framework, of the IGF. You should, you should ask a lot of us, and not just in the terms of this sort of guidance, but capacity building. We do some very useful capacity building where we do a course with the OECD, where one side uses the OECD model and one uses the UN model. It's held in Vienna each year, and it's very good. Even if you're on a side which is using the OECD model, you get to see the perspective of the country that uses the OECD model, and hopefully they get to see the perspective of countries using the UN model. So be demanding. You have a right to have guidance that helps you make a difficult job as easy as possible, and it's our obligation to make that job as easy as possible, and to encourage sustainable development, which is good for the country in the long run. So that's my final comments. Thank you very much to the IGF for a very valuable practice note and very valuable continuing contribution in this area. And I will leave it to you, Ali, if you have any final. I apologize that we went late, but for all the right reasons, such valuable comments. Ali.
Thank you, Michael, and thank you for doing such a great job moderating the session today. Thank you to all our panelists, to Carlos, to Tuxu, to Amadou, to Jacqueline, to all of you for making time to be with us today. We really appreciate your expert insights on this topic and your support in the development of our practice note. Thank you to our audience for sticking with us. We hope it's been useful for you. Please do download the practice note, have a read. There's lots of content in there that we hope can be valuable to you in designing and negotiating your treaties. It will be available shortly in French and Spanish as well. And finally, as Michael mentioned, alongside the UN and the OECD, the IGF provides capacity building in this area. So we've been providing training on negotiating tax treaties for the resource sector. So if that's something that is valuable to your country, then please feel free to get in touch and continue the conversation with us. So thank you, everyone. And with that, we consider this practice note officially launched. So thank you again, Michael, for steering the ship today. Take care, everyone.
Thank you all. Bye.
Thanks, everyone. Bye-bye.